Good afternoon. FOMC meeting 9/21/2011. Markets got taken to the woodshed. But we're going to talk about a topic on bears, and this is a 3x bear technology. And we're taking a look at how the bear has made a multi-year weekly base on the bottom. And for the full calendar year, this particular bear refuses to break that baseline, and we're coming back to it today. And it was a bottom up. It's a weekly chart up here now. Okay, it says 800 weekly. Now MMTs, the lesson to be learned here, moving forward through the rest of this calendar year, is this is the multi-year. We broke higher, we broke down, then we tested it, and we broke back to the base here, and we made all-time highs in that bear. When we rallied in certain days in volatility over the long week, as we're pulling back here, and we got another refusing area that if this bear starts to build another weekly, daily, and weekly, and you can see right here that this is today, day 3 of this week. But it's not coming down to even test the base. It's starting to form up here. But the lesson to be learned in all bear funds, is we must go through them all, because if we do break the lows, the S&P, and today was an FOMC meeting day, and there was quite a haircut right here on these indexes. And the volatility index is rising, which also, if that's fear, if this VIX is going to really break higher, and the VXN, and this is a daily breakout. These were the highs in the cycles, but we are going to build a base. And the thing about it is that when you are building a weekly base here, this is today's S&P went down 35 handles today. And the thing about it is the bear 3x technology is got a multi-year base with a higher high coming out of the original accumulative weekly base within the weekly ranges of a calendar year. And then the breakout, and then the pullback. And if we don't break higher and we start to continue our reversal, that right now we have a reversal on the S&P at 1220 down. In the last cycle, I already did the S&P chart. It's how you build yearly bases. And the bear has been building a yearly base. And it's very, very stubborn. And technology says that if technology fails, then this ETF is worth buying. And you got to know when to put bear trades in your portfolio against your bull runs, or shorting the bull run and buying the bear for your portfolios. You need to get very diversified in trade management, diversification and risk management, to weight yourself in these markets correctly. And don't feel bad about it. You can get to skill here. It's okay. That's why we're here. We're here to address this. And we're here to bring awareness. And we're here to let you know that if we do come down and break the calendar year lows in the indexes, then naturally this is going to go back up, and we would look to see on a weekly level going into the closing year, if we have a reversal here, is how we would come back up and break that top. But most importantly is it's a yearly base, calendar year 2011. And you can always sign up for our bear and bull risk management weighted market trades, and how to apply the correct risk management for longer term management holdings. And how do I diversify my risk And why? Bear tech, multi-year weekly base. If it breaks it, then the technology bull, which is another one called a TYH, and I'll bring it up. There is the bull. 3X. Technology bull. Boy, it had a great move up here to resistance, this ETF. $5, $6, $7 trades here. It's a weekly bottom, volatility along with all indexes as well. But the upside reversal is here. Now, on the other hand, when you hear me talking about this bear putting in a multi-year bottom, well, we're putting in multi-yearly tops over here. Just the opposite. So when we were reversing here, we were breaking out here. And when we were reversing here, we were breaking out of the base up to resistance here. And when we rallied up here, then this bear came back down and tested its base. My point of it is this is a yearly top in the bull. And the tops, you can tell here what these tops, MMTs, is that if I come down and shoot it right here, my highs, these are reversals, and these weekly highs are a lot lower. And if I come from over this one here and I come right down to here now, watch that one, that second trend line right there. Notice that the highs are a lot lower and that the yearly bottom volatility for the bull has big down days, and notice we have big up days on the bear, but the bear has built a bottom and this has built a top. And when the tops are much lower in the overall weekly trend structure and you cannot get back above levels to consolidate and make higher, then this has got support on a weekly level and will go that way again, and we will see if we come down and break the yearly lows. Because if we break higher here, then that means you need to be short the bull and let the bear run. But most importantly in the lesson is the multi-year weekly highs have been put in as the weekly bear lows are being built and consolidated, as they should. You know, you break out, you hit resistance, you pull back to the base, you break and make a higher high, and then you pull back again. And this is all yearly volatility. In September on an FOMC meeting day, how do I look at tech bear and tech bull on a weekly management level? And how do I diversify my risk with both ETFs? Whether I'm buying long and selling short the bull at times, or I'm going long the bull and shorting the bear back down, it doesn't matter. What does matter is how you engage with the right trade management, which equals risk management, which is a very, very, very rare thing that people do or know how to do or how to deploy. But if you're an innocent bystander watching this, I would scratch my head if I were you, and I'd start thinking, oh, wow,